Right. So you have finally retired. You have handed in your lanyard. You have said your goodbyes. And you have sat there with a brief thing. Lovely. That's HMRC's never speaking to dead lot again. Bro, that wrong, mate.
Retirement is not the finish line with the text.
It's actually the start of a brand new admin marathon. And the cruel bit, nobody hands you a checklist. HMRC just sits back, quits anything, and waits to see if you sort your own affairs out. If you do not, you either lose money, you are out, or you get landed with a bill that absolutely guts your saving. Today we are going through 5 things HMRC fully expected you to handle the second you stop work. And honestly, most retirees miss every single one. Let's crack on.
Red flag 1. The national insurance gap. First one sneaky because it's not even about tax, it's about your state pension. / and it's a job you should have done before you fully stopped working, but most people only realize once it's too late. Your state pension amount isn't automatic, it's built on your national insurance record. You need roughly 35 qualifying years for the full amount. If you've had gaps, a stint abroad, time off raising kids, a few self-employed years where you didn't pay enough, those gaps shrink your pension. HMRC expects you to spot the gaps and decide whether to plug them with voluntary Class 3 contributions. Sounds dull, but the maths is properly mad. Filling one missing year can cost a few £100, but it can add hundreds of pounds a year to your state pension for the rest of your life. Get it wrong, or just never check, and you're knowingly walking into retirement on less money than you're entitled to. Log into your personal tax account and check your NI record before you call it a day, not after. Red flag 2. The MPAA trap, 245 to 415. Right, this one catches out the retirees who think, I'll dip into my pension and keep paying into it / big mistake if you don't know the rules. Normally you can pay up to £60,000 a year into your pension and get tax relief on it. Lovely. The second you flexibly draw taxable income from a defined contribution pension, even a small drawdown payment, HMRC slams a permanent limit on you called the Money Purchase Annual Allowance, or MPA. That limit drops to just £10,000 a year, and here's the brutal part, it's a one-way door. It's triggered for life. No appeals, no resetting it next tax year. So if you're still working part-time, still wanting to top up your pot, and you take even one taxable lump sum the wrong way, you've just permanently shrunk your future tax relief. HMRC expects you to know this before you press withdraw, not after your pension provider sends you the letter explaining what you've just done to yourself. Red flag 3. The savings interest stealth tax, for 15 to 545. Now this one's bitten loads of pensioners recently, and it's almost cruel because it punishes you for doing the sensible thing, saving your money. You get a personal savings allowance, £1,000 tax-free interest if you're a basic rate taxpayer, £500 if you're higher rate. But interest rates have been decent the last couple of years, and a lot of retirees have moved their lump sums into easy access savings accounts and fixed bonds, just to keep things safe. Add your state pension, a private pension, and a decent chunk of savings interest together, and plenty of pensioners are sailing straight past their allowance without even noticing, because nobody's deducting tax automatically on savings interest like they do on wages. HMRC finds out through your bank reporting interest directly to them, and if you owe under £3,000, they don't send a polite reminder. They just adjust your tax code, or fire off a simple assessment bill, completely out of the blue. The fix is dead simple, actually add up your total expected income for the year, including interest, before the tax year ends. Not after HMRC's already done the sums for you. Red flag 4. The 2027 pension inheritance bombshell, 545 to 730. This next one is genuinely massive, and most retirees haven't got a clue it's coming, even though it's already locked into law. For years, your unused pension pot has basically sat outside your estate for inheritance tax purposes. It was one of the best-kept secrets in financial planning. You die with money still in your pension, and your family inherited it largely free of IHT. That's changing. As of the Finance Act 2026, from the 6th of April 2027, most unused pension funds and death benefits get pulled into your estate for inheritance tax. If your total estate, house, savings, and now your leftover pension tips over the threshold, your family could be facing a 40% tax bill on money you spent your whole life building up.
A plain
There is
brown
good news,
envelope dropping
anything
through the
left to a
letterbox
spouse
in
or
slow
civil
motion,
partner is still exempt,
landing
and
soft
gifts
on
to
the
charity
doormat in
stay
the hallway
exempt
light.
too.
That's never good news, is it?
But if you're planning to leave your pension to your kids or anyone else, HMRC expects you to review your expression of wish form and your overall estate plan now, while there's still time to plan properly, not in 2027, when the rules actually bite. Red flag 5, the missed pension credit claim. Right, let's end on something that actually puts money back in your
Quick
pocket.
whip pan blurring through the hallway, easing into a soft fade to black.
Pension
On we go.
// if your weekly income's below a certain threshold, this tops up your state pension, and a shocking
That's never
number of
good news,
eligible
is it?
pensioners never claim it because they assume their savings, or their little workplace pension, rules them out. // often it doesn't. Here's why it actually matters way more than the weekly amount
That
suggests.
boundary line
Claiming
stretching
pension
outward,
credit is at
slowly
passport to a
swallowing
whole
the
stack
pension
of other
pot
help,
icon
your
whole
winter fuel
until it
payment,
sits
a
fully
free TV
inside with a
license
red
if you're
outline
over
pulsing round
75,
it,
council
right inside
tax
the net now,
discounts,
mate.
even
That
help
boundary
with
line
NHS
stretching
costs.
outward, slowly swallowing the pension pot icon whole until it sits fully inside with a red outline pulsing round it, right inside the plan to get parred on. Properly unbalance that.
Miss the pension credit claim, and you can lose the lot in one go without even realizing it. // it takes 15 minutes on the gov.uk pension credit calculator. // loads of pride gets in the way of this one, don't let it. // check it, even if you think you won't qualify. OUTRO, the golden rule. So there you go, 5 things HMRC fully expects you to sort out the moment you retire, and most people stumble into every single one of them blind. The golden rule simple retirement isn't a one-off event for HMRC, it's a fresh set of rules. // check your national insurance record, know your MPAA limits before you draw down, keep an eye on savings interest, get your estate plan sorted before 2027, and don't let pride stop you claiming what you're owed. If this saved you from a nasty surprise, smash that subscribe button. We cover UK pensions, tax traps, and
Finally,
retirement
some good
updates
news,
every
eh?
single week here at the Tax and Pension Brief UK. Let us know in
Pension
the comments
credit
which one of these
calculator.
caught you out. // cheers for watching. Take care of yourselves.
Sorted, just like that. Go. Go on then. Give it a tap, mate. Ta-ra for now.